Chapter 13, Learning Objective 4, decide which of the 4 long-term investment strategies you will utilize. I feel like the book treats these strategies as they're mutually exclusive. That's not the case. Just because you employ one doesn't mean you can't employ the other. And hopefully you'll understand as we walk through these what I mean. So, establish your long-term investment strategy. What markets you're going to invest in. You have to think about bear markets versus bull markets. Bear markets are when the markets are going down. Bull markets are when the markets are going up. It's never a bad idea to invest in when after the market is taking a hit. A lot of people follow stocks and they invest in stocks when they miss earnings and so forth, and make a considerable amount of money by doing so. If you had invested in the stock market at the end of 2008, the stock market, the S&P 500 lost about 30%. You would have recouped your earnings, your losses, in less than 2 years. So it's, if you can get somewhere close to the bottom, you can, and when you invest, you certainly can make out. You can also lose considerably if you invest at the top. So if you invested at some point in 2006 or 7, you probably took a pretty big hit. So market corrections occur. That's what we're talking about. When a recession, when recessions hits, we know the market's going to go down. The market also corrects after the pattern of stock market prices typically is there's a little bit of what we call irrational exuberance. Investors get too excited, prices go up too fast, then at some point there are corrections, so there will be a decline in the market. We've seen some declines recently with regard to the potential for a trade war. Long-term investors avoid trading mistakes. They don't practice market timing. I'm not, by what I was saying previously, I'm not promoting it, but I'm just saying if you have money and the market's down, it's probably a good time to invest. On the other hand, if you have money and the market's way up, it might be advisable to wait to put your money in, or put a portion of your money in over a period of time. Put it in monthly or quarterly or something of that nature, so that you're not fully exposed to that risk. Avoid herd behavior. Don't just chase the market. Don't invest in things just because everybody else is. You avoid trading too much. Trading too much costs money. Active trading typically is outperformed by passive investing. This has been very true since the financial crisis. Very few active traders have outperformed the market on a consistent basis. Avoid buying high and selling low. That actually should be low there. First strategy is buy and hold, and it anticipates long-term economic growth. Simply buying your investment, and you're going to stick with it. Yeah. The strategy 2 is dollar cost averaging. So alluded to this just briefly a minute ago. Dollar cost average is simply investing a portion and putting some money in that investment on a regular basis. That allows you to average your investment into that, and as a result, it allows you to reduce your cost associated with investing in that stock. It's dollar cost averaging is a great idea. That dollar cost, if you have a 401k, you are dollar cost averaging because you are investing in that, putting money in that investment every month. That is by definition, dollar cost averaging. Dividend reinvestment plans also allow you to some extent, dollar cost average. So the dollar cost averaging is a great idea in a fluctuating market. It allows you to buy the stock at a reduced average share price. This table 13.1 is a dollar cost averaging example. We can see the fluctuating market on the left. This person invested $300 each time. The prices fluctuated. They bought a different number of shares each time, but as a result, their average cost, which is only $12.50 versus an average share price of $13. The same is true in a declining market. The average share price was $9.20. The cost is only $7.89. And same is true in a rising market. So highly recommend investing in your 401k or IRA and dollar cost averaging. It's a great way to invest and reduce your risk or exposure to the market. Portfolio diversification. Again, these strategies are not mutually exclusive. It's a great idea to dollar cost average along with and diversifying your portfolio. As I mentioned previously, you can be diversified with a portfolio of 40 stocks. This is most easily accomplished by purchasing a mutual fund or exchange traded fund. The one thing to note, these fees on exchange traded funds are considerably less than they are on mutual funds. And there's essentially no performance difference between exchange traded funds and mutual funds. What diversification does is it averages out the investor's return. We saw that dollar cost averaging averaged out the cost of purchasing the investment and reduced the cost of buying that investment. The same is true of diversification. Within any portfolio, you're going to have winners and losers, and the fact that investments are what we call negatively correlated, meaning that some go up when some go down, allows you to actually end up with a less risky investment portfolio. So that is the goal and the objective of diversification. So the table 13.2 shows an example of diversified and undiversified. So if you can see the first one, they had 10% in cash, 45% in bonds and equities, and the example here, the stocks go up 10%. That portfolio went up $9,000. If they crashed or went down 50%, you lost $45,000. Not a great thing. But if we go down to the one below, where we're in 85% equities, stocks going up 10%, we gain $17,000. However, we lose $85,000 when the stocks crashed or went down 50%. Asset allocation is simply keeping your assets in in specific asset classes and investment categories that fit your time horizon. Again, all of these strategies, they're not mutually exclusive. You can practice asset allocation with a diversified portfolio, and you can also do so with dollar cost average. You can rebalance your portfolio to maintain that asset allocation. So that's what asset allocation does, is it maintains specific percentages in specific groups of assets over time. Typically, investors might rebalance quarterly, semi-annually, or even annually. The Figure 13.4 gives you some model portfolios for different time horizons. A 0 to 5 year time horizon. On the top here we have a high risk or aggressive portfolio. We have 60% in bonds. If we're in a moderate portfolio, 60% in equity. If a moderate risk portfolio, we'd have 40% in equity. A low risk portfolio, we'd have 25% in equities. If we go to 6 to 10 years, we've got 80% in equities and the high risk, 60% for the moderate, 40% in the low risk or conservative. If we go out 11 years or more, high risk or aggressive would be 100% in equities. The moderate would be 80% equities. So, point being is your time horizon is very important as to how you invest. If you're going to need your money in the near future, it is very unwise to invest in the markets. For example, if you had $20,000 and you were planning to buy a car in 1 year, it would be a very bad idea to buy bonds or stocks. So, Figure 13.5 shows an example of rebalancing your portfolio. Day one, you have a portfolio that's 50% in bonds, 10% in cash, and 40% equity. 1 year later, the bonds has fallen, the equities have grown. So if you were practicing asset allocation, you would want to rebalance. You would sell some equity. You would put some money into cash to get it back to the 10%, and you would put the rest into bonds to get that back up to 50%, assuming those were your asset allocation goals. Concept check 13.4 summarize what the buy and hold strategy is all about. The buy and hold strategy is making sound investments in a diversified portfolio and staying invested. Explain the concept of dollar cost averaging, including why one invests at below average costs. Dollar cost averaging means that you invest a set dollar amount on a regular basis. The result is that you pay a lower average share cost over time. What is the goal of portfolio diversification? How is it accomplished? The goal of diversification is to eliminate unsystematic risk by purchasing multiple investments. And again, I mentioned the current finance theory suggests that the diversification can be achieved with a minimum of 40 stocks. What is asset allocation? Why does it work? Asset allocation means that you put money into multiple markets and you identify set ratio for the mix. Worst financial blunders in investment fundamentals: buy and sell more than you should, diversify less than you should, hold on to a bad investment too long after evidence shows that it was a bad decision. Finally, do it now. Break down your personal investment philosophy. recording the percentages you would like to allocate to stocks, cash, and equivalents using an asset allocation strategy to save for retirement. Start to save even a small amount, perhaps by signing up to automatically transfer money every payday to a savings or investment account.